Let's do a deep dive into bonds and how they work. Before I moved to the West Coast, I worked in the bond market on Wall Street for 13 years. I started my career at JP Morgan underwriting mortgage bonds. After JP Morgan, I worked for a bond insurer, Assured Guaranty, for 7 years. I started in data analytics, then moved to risk management. A bond is an investment where someone lends money to the government or a corporation, and the investor receives an interest payment for the amount of time the bond is active. It could be a fixed rate or adjustable. The entity that sold the bond pays interest in addition to the original face value of the bond. Bonds are used by companies, municipalities, states, governments, etc. to finance projects and day-to-day operations. Owners of bonds are debt holders or creditors of the issuer. When you own a bond, you want to know the end date, that's the maturity date, when the bond principal is due to be paid, and whether you receive a variable or fixed interest rate. Some people refer to a bond as a fixed income instrument, since many bonds pay a fixed interest or coupon to the debt holder. And bond prices are inversely correlated with interest rates. When rates go up, bond prices fall. When rates go down, bond prices go up. At the end of the video, I'll do a lot of bond math if you're interested in that part of it. Each bond has a maturity date at which point the principal must be paid back, or else the entity selling the bond will go into default. That's pretty much the definition of filing bankruptcy, when you can't pay back the principal and interest on your debt. So how do bonds work? Well, bonds are debt instruments and represent loans made to the issuer. It's just a loan, an IOU. Also, bonds allow individual investors to assume the role of a lender, like a bank. So if you're a business or individual, you could borrow from anyone, not just a bank. Governments and corporations use bonds to borrow money to fund roads, schools, dams, and many different types of infrastructure. That's pretty much how our country got built, on bonds. And there are many really large corporations and really small companies that borrow to grow their business. They use the funds to buy property, to buy equipment, undertake new projects. They also use the money to fund expenses like payroll for R&D. When you think of investing, you think of stocks and bonds. Stocks are equity securities, bonds are debt securities. When a bond is issued, the terms include the loan amount, interest payments, when the payments will be made, the maturity date. The interest is part of the return to the bondholder. That's part of the yield they receive for taking the risk of investing. Another term for interest rate is coupon rate. The initial price of most bonds is usually $1,000, so the face value of the bond is $1,000. The actual market price of the bond depends on the credit quality of the issuer, the time until expiration, the coupon rate, and the coupon rate is always compared to the rate in the open market. So if you have a bond that pays a 5% fixed interest rate, and rates go up to 6, 7, 8, 9%, the value of your bond goes down because your bond is only paying 5%, while someone could take the same risk and receive 8%. So the value of your bond goes down. Let's say last year, bonds were yielding 7%. Now this year, the same exact bond is yielding 4%. Now the value of your bond goes up because you're receiving 7%, and your friend is taking the same risk and buying a bond at 4%. In 2023, you bought a US bond with a 7% coupon. So you paid $1,000 and you're gonna receive $70 of interest because 7% times 1,000 equals 70. So your yield is 7%. Your yield is your return. $70 over 1,000 equals 7%. Say for instance in 2024, interest rates drop a lot. The same exact bond is offering a coupon at 4%. And if your friend buys that bond, he'll receive $4 a year, 4% times 1,000. So his yield is 4%. You both have the same exact bond, the same exact risk. So obviously you're doing a lot better. But what if you wanted to sell your bond in the open market? Since the 2024 US bond is yielding 4%, you have to sell your bond with the same exact yield. But your bond offers a $70 coupon, so you can't sell it for $1,000, you have to sell it for more. So it's just simple math. $70 over 4% equals $1,750. So you can sell your bond for $1,750 in open market because anybody who buys it receives $70 a year, which is a 4% yield. The 5 main characteristics of a bond. The first is the face value or par value. That's the value of the bond at maturity. And that's the amount the bond issuer uses when calculating interest payments. The second most common term is coupon rate, the rate of interest the bond issuer will pay on the face value of the bond. It could be as low as 1-2%, as high as 10, 12, 15%. The third most common term is coupon dates, the dates the bond issuer will make interest payments. It could be monthly, it could be quarterly, it could be annually. Some bonds don't pay any interest until the very end. Those bonds are called zero coupon bonds. Let's say you want to calculate the yield to maturity on a zero coupon bond. Remember, yield to maturity is the rate of return if you hold the bond until maturity. Zero coupon bonds always trade at a discount. The interest is paid at maturity when the bond is redeemed. In this example, you pay $95,238 and receive $100,000 in 1 year. So that's really your interest, that $47.62. So let's calculate the yield. Here's the calculation for YTM. It's the price of the bond times 1 plus yield to maturity. That's the unknown. That's what we need to figure out. Equals the face value of the bond. Let's plug in what we know. The price the bond is trading in the open market, $95,238. That's right here, that's given. Times 1 plus yield to maturity equals the face, what you're going to receive at maturity, $100,000. We need to isolate the unknown, the YTM. So we divide both sides by 95,238. Now we have 1 plus yield to maturity equals 100,000 over 95,238. So now we have 1 plus YTM equals 1.05. 1.05 equals 100,000 over 95,238. Next, we need to subtract 1 from each side. Now we have YTM equals 0.05 or 5%. So would you pay $95,238 to receive $100,000 in 1 year? That's a decent return, 5%. If this was a government bond, it's a really good return. If this was a corporate bond, it may be questionable depending on which company is issuing the bond. If interest rates go down, the price of the bond will go up. Say it's $98,000 a year from now. Now you're yielding only 2%. But if interest rates go up a lot, and say the price is $90,000, now you're yielding 11.1%, which is a really good return. The fourth term is the maturity date, the date the bond will mature. Also the date the bond issuer will pay the bondholder the face value of the bond, the principal. If you bought a $1,000 zero coupon bond, you would not receive periodic interest payments until the very end. The fifth most common term is issue price, the price at which the bond issuer originally sells the bond. In most cases, the bonds are issued at par, which means you pay $1,000 for a $1,000 bond. Sometimes bonds are issued at a premium or discount, so you may pay more or less than the face value of the bond. And the reason you'll pay more or less is based on the interest rates in the open market. There are 4 categories bonds are sold in the markets. The first is corporate bonds, the second is muni bonds, the third is government bonds, and the fourth is agency bonds. Corporate bonds are issued by corporations. So instead of Apple going to the bank and getting funds, they can just issue bonds. Because Apple rather pay bondholders 3% than the bank 5 or 6%. The second category is muni bonds, municipal bonds. These instruments are issued by states and municipalities. And there's usually major tax advantages when you buy muni bonds, especially if you buy a bond in your state or county. The third category is government bonds. These are bonds issued by the US Treasury, and if the maturity is a year or less, they're called bills. And if the maturity date is 1 to 10 years, they're called notes. And if government bonds are issued with more than 10 years to maturity, they're called bonds. Dun dun dun. The entire category of bonds issued by our government treasury is often collectively referred to as treasuries. Then the fourth category, agency bonds. These are issued by government-affiliated organizations such as Fannie Mae or Freddie Mac. Let's talk about bond prices and interest rates. A bond's price changes daily based on supply and demand. If an investor holds a bond until maturity, they will get their principal back plus interest. However, a bondholder can sell their bonds in the open market where the price fluctuates. And as I mentioned earlier, the price of the bond varies inversely with interest rates. So as rates go up, the value of your bond goes down. And if rates go down, the value of your bond goes up. It's the same thing as a home mortgage. If you borrowed $200,000 from the bank and paid them 6% interest, and let's say 2 years later, your friend gets a mortgage and pays 4% because rates went down. So the cost of your bond goes up. You're paying more money for your bond, which is not a good deal. You want to pay less money. So if you were smart, you'd refinance your mortgage loan. And if you got a mortgage loan at a 4% interest rate, and in 5 years rates doubled to 8%, the price of your bond went down because rates are going up. So you're paying a lower price, which is really good. You'll be the envy of your community because you're paying a lot lower than they are. Let's do an example. Say a company issues a $1,000 par value bond paying a 10% annual coupon rate. That means each year the bondholder receives $100, 10% of $1,000. What if interest rates drop and this same exact bond is now trading at 5%? So if somebody bought the bond in the open market, they would get $50 of annual interest. But you still receive $100 because when you bought the bond, it paid a 10% fixed rate. If you traded your $1,000 10% bond in the open market, you would get $2,000 for it. Because if somebody bought your bond for $2,000, they would get $100 of annual interest, which is a 5% interest rate. When you bought the bond, the interest rates were 10%. Since interest rates go down, the value of your bond goes up. But what if the opposite happened? Instead of interest rates going down to 5%, they went up to 15%. That means someone can invest in the same exact bond as you bought, but they would receive $150 of interest. They would invest $1,000 and receive $150, even though you're only getting $100 for that $1,000 investment. If you tried to sell your bond in the open market, no one would pay $1,000 for it. They would pay a lot lower. They would pay 666.67. Because why would they give you $1,000 and get 10% when they could buy the same exact bond and get 15%? Let's now discuss yield to maturity. So the yield to maturity is the total return anticipated on a bond if the bond is held until maturity. Yield to maturity is the internal rate of return of the investment. It's actually a really useful tool. It helps investors evaluate the attractiveness of one bond relative to other bonds with different coupons and maturity dates. You're able to measure the anticipated changes in bond prices given a change in interest rates, assuming you're comparing a bond with the same duration. Duration represents the price change in a bond given a 1% change in interest rates. The official term is modified duration. Modified duration is an extension of the Macaulay duration. So in order to calculate modified duration, you have to calculate Macaulay duration first. Macaulay duration calculates the weighted average time before a bondholder receives the bond's cash flows. As a bond's maturity increases, duration increases. And as a bond's coupon and interest rate increases, its duration decreases. So it's a really important number for portfolio managers, financial advisors, or investors like me and you to understand. Assuming all other risk factors are equal, bonds with higher durations have greater price volatility than bonds with lower durations. To calculate duration, you need the price of the bond, coupon, maturity date, and interest rates. As maturity increases, duration increases, and the bond becomes more volatile. As a bond's coupon increases, its duration decreases, and the bond becomes less volatile. As interest rates increase, duration decreases, and the bond's sensitivity to further interest rate increases goes down. We're going to calculate Macaulay duration on a bond, but just to summarize everything, bond duration measures the sensitivity of a bond's price to changes in interest rates by calculating the weighted average time it takes to receive all the interest and principal payments. The longer the duration, the more sensitive the bond is to interest rate changes. Macaulay duration is measured in years. It tells us the weighted average maturity of the cash flows from a bond. It tells us how long it will take to receive the cash flows. The higher the duration, the more sensitive the bond is to interest rate changes, so it's more volatile. Let's say we bought a 3-year bond for $1,000. The coupon was 4%, but interest rates are going up, so the current yield in the market is 4.5%. In year 1, we receive $40 in interest payments, and then we have to present value that number by the 4.5%, by the current yield. So the calculation is 40 divided by 1 plus 4.5% raised to the first power. So that's 3828. And we multiply that by 1. We receive $40 in year 2. We present value that number back to today, which is 3663, which makes sense. It's lower than 3828 because we're present valuing it 2 years instead of 1 year. And then we take 3663 times the number of years. We get 7326. And in the third year, we get $1,000 back plus the $40 of interest. We present value that and we get 91135. We take that number times 3 and we get 2734. So the value of the bond in the open market today is 986.26, which makes sense because rates went up, so the value of the bond went down. We paid $1,000 for the bond, but it's only worth 986.26 today. And to calculate the Macaulay duration, we take the present value of the time-weighted cash flows at 2845 divided by the 986. That gives us the number of years. Here's the calculation right here, 2845 over 986. The Macaulay duration is 2.9 years. That's the weighted number of years to receive the cash flows from this investment, a little under 3 years. If we were comparing this to another bond in the market, say that bond had a Macaulay of 4.3 years, then that means this bond is exposed to more interest rate risk. Because when a bond has a higher Macaulay duration, it's more sensitive to changes in interest rates. So how do you invest in bonds? It's pretty easy. You can just go to a website like E-Trade, Fidelity, pretty much any broker. Maybe not any broker, but a lot of them. If you want to buy treasury bonds or TIPS, those are sold directly from the federal government. The website is treasurydirect.gov. New issues of U.S. Treasury bills, notes, bonds, savings bonds, and TIPS are all available from Treasury Direct. And you should definitely use this site because you don't have to pay any commissions and fees. You're eliminating the middleman, the broker or bank. In order to open a Treasury Direct account, you need a Social Security number or EIN. Also a US address and a checking or savings account. And there's pretty much zero risk, or as close to zero as you can get, because the principal and interest payments are backed by the full faith and credit of the US government. The US government uses the funds to finance its federal debt. Everything is electronic. You can purchase and redeem Treasury securities directly from the US government. I'll talk about the 6 main types of securities you can buy from Treasury Direct. The first one is Treasury bills. A T-bill is a short-term debt obligation backed by the US government. It has a 1-year maturity or less. They're sold in denominations of $100 and reach a maximum of $10 million. The second is Treasury notes. A treasury note has a fixed interest rate and maturity between 2 and 10 years. The third is a treasury bond, and treasury bonds have a maturity of 20 or 30 years. And these securities pay semi-annual interest payments. The fourth most common security are Series I bonds. These bonds give investors a return plus inflation protection. Also, Series I bonds cannot be bought or sold in the secondary markets. And you receive a fixed rate of interest for the life of the bond. Also, a variable inflation rate that's adjusted each May and November. These bonds have a 20-year initial maturity with a 10-year extended maturity for a total of 30 years. The next security is the EE savings bonds. These bonds are guaranteed to double in value over their 20-year initial term. Some EE bonds pay interest beyond the original maturity date, up to 30 years. The minimum investment is $25. Every investor can purchase up to $10,000 in these bonds each year, so no more than $10,000 in a calendar year. And the sixth most common security by the federal government is TIPS, Treasury Inflation Protected Securities. These bonds are indexed to an inflationary gauge to protect investors from a decline in the purchasing power of their money. The principal value of TIPS rises as inflation rises, while the interest payments vary with the adjusted principal value of the bond. So the principal amount is protected since investors will never receive less than the originally invested principal. Bonds can vary on the interest rate, the maturity dates, whether they can be recalled by the issuer. Let's go through some of the common ones. Z bonds, zero coupon bonds. These bonds do not pay coupon payments. Instead, they're issued at a discount to their par value. Let's say you want to calculate the yield to maturity on a zero coupon bond. Remember, yield to maturity is the rate of return if you hold the bond until maturity. Zero coupon bonds always trade at a discount. The interest is paid at maturity when the bond is redeemed. In this example, you pay $95,238 and receive $100,000 in 1 year. So that's really your interest, that $47.62. So let's calculate the yield. Here's the calculation for YTM. It's the price of the bond times 1 plus yield to maturity. That's the unknown. That's what we need to figure out. Equals the face value of the bond. Let's plug in what we know. The price the bond is trading in the open market, $95,238. That's right here, that's given. Times 1 plus yield to maturity equals the face, what you're going to receive at maturity, $100,000. We need to isolate the unknown, the YTM. So we divide both sides by $95,238. Now we have 1 plus yield to maturity equals $100,000 over $95,238. So now we have 1 plus YTM equals 1.05. 1.05 equals 100,000 over 95,238. Next, we need to subtract 1 from each side. Now we have YTM equals 0.05 or 5%. So would you pay $95,238 to receive $100,000 in 1 year? That's a decent return, 5%. If this was a government bond, it's a really good return. If this was a corporate bond, it may be questionable depending on which company is issuing the bond. If interest rates go down, the price of the bond will go up. Say it's $98,000 a year from now. Now you're yielding only 2%. But if interest rates go up a lot, and say the price is $90,000, now you're yielding 11.1%, which is a really good return. Treasury bills are zero coupon bonds. As I mentioned, zero coupon bonds do not pay interest. They're purchased at a discount to face value, but they're repaid their full value, their full par at maturity. So if you invested in a $10,000 3-year bond paying 6% interest, and you wanted a similar yield on a zero coupon bond, you may pay $9,200 for that bond. You would get that bond at a discount, since you're not going to receive any interest payments. The calculation for a zero coupon bond price is maturity value divided by 1 plus the required interest rate raised to the number of years to maturity. The imputed interest, sometimes it's called phantom interest, is the estimated interest rate. So the imputed interest on the bond is subject to income tax. Most zero coupon bonds have a maturity of 10 or more years, but you need to consider that phantom interest. Even though you don't receive actual interest payments, you still have to pay taxes on the interest you don't receive. Let's go back to the bond variations. I'm going to be talking about 4 variations. The first one we did, Z bonds. The second one is convertible bonds. The third is callable bonds. And the fourth is puttable bonds. So let's talk about convertible bonds. These are debt instruments with an embedded option that allows the bondholder to convert their debt into equity. So they can convert the debt into the common stock of the company that issued the bond. It's their option. They don't have to convert it to equity. A convertible bond usually pays fixed interest payments, but can always be converted into a predetermined number of common stock shares. Some people refer to this as a hybrid security that has features of a bond, while having the option to own the underlying stock. The conversion ratio determines how many shares of stock you can get from converting the bond to equity. For example, a 5-to-1 ratio means that one bond would convert to 5 shares of common stock. The conversion price is the price per share at which a convertible security can be converted into stock. The conversion price and ratio can be found in the bond indenture or the prospectus. If you have convertible bonds, you would look at the indenture. If you have convertible preferred shares, you would look at the prospectus. Sometimes bond issuers might force or exercise their right to call the bond if interest rates are favorable. With a forced conversion, the investor does not have a say in holding or converting their bond. One version of convertible bonds is known as death spiral debt. The bond is converted into a fixed dollar value paid in shares. Investors holding this security will convert if the stock price declines substantially. This further dilutes shares and drives the price even further downward. Convertible bonds offer lower interest rates compared to regular bonds because of the added potential for equity participation through the conversion. So regular bonds offer higher interest rates to compensate investors for the absence of equity upside. Convertible bonds are traded in the secondary market, which means investors can choose to buy or sell them before maturity. Regular bonds also trade in the secondary market. The same company may offer regular bonds and convertible bonds, and it's the investor's option to choose which one they want. Sometimes a portfolio manager uses convertible bonds to rebalance their portfolio. If an investor feels they're overweight in debt instruments, they could just convert some of the bonds instead of selling them. So that type of flexibility you don't get with regular bonds. Let's talk about callable bonds. These bonds have an embedded option, but different than convertible bonds. A callable bond can be called back by the company before it matures. So it's riskier for the bond buyer because the bond is more likely to be called when it rises in value. A callable bond allows companies to pay off their debt earlier and benefit from favorable interest rate drops. It also benefits the investor because investors are compensated with a more attractive interest rate than non-callable bonds. So in simple terms, a callable bond gives the issuer the right to return the investor's principal and stop interest payments before the bond's maturity. So if a company expects interest rates to fall, they may issue the bond as callable, which would allow them to make an early redemption and secure other financing at a lower rate. It's the same thing as if you have a home mortgage. If you're paying 6% interest, why wouldn't you just refinance and pay 4%? You want to get rid of the debt. You could think as a home loan as a callable bond. The earlier in a bond's lifespan, the higher its call value will be. For example, a bond maturing in 2030 can be called in 2025. It may show a callable price of $102. This price means the investor receives $1,020 for each $1,000 in face value of their investment. The bond may also stipulate that the early call price goes down to $101 after a year. Treasury bonds and treasury notes are non-callable. Most muni bonds and some corporate bonds are callable. For example, a muni bond has call features that may be exercised after a set period, such as 10 years. The fourth and last bond variation is puttable bonds. This security allows the bondholder to put or sell the bond back to the company before maturity. This can be a valuable tool for investors that may be worried that a bond may fall in value if they think interest rates will rise. So they want to get their principal back before the bond falls in value. A puttable bond trades at a higher value than a bond without a put option if you compare apples to apples. Bonds with the same credit rating, maturity, and coupon rates. The embedded put option is an incentive for investors to buy a bond with a lower return. The put option can be exercised upon the occurrence of specified events or conditions or at certain times. Every bond is different, so you have to look at the terms. So what determines a bond's coupon rate? Two features of a bond, credit quality and time to maturity, are the principal determinants of a bond's coupon rate. If the issuer has a poor credit rating, the risk of default is greater and these bonds pay a higher interest rate. For example, GameStop would pay a higher interest rate than Nvidia. Bonds that have a really long maturity date also pay a higher interest rate. The higher compensation is because the bondholders are more exposed to interest rate and inflation risks for a longer period of time. Let's talk about how bonds are rated. There are three main companies that rate bonds: S&P, Moody's, and Fitch. S&P stands for Standard & Poor's. High quality bonds are called investment grade, BBB or better. The US government offers investment grade bonds, so do stable companies like Microsoft. Bonds that are not considered investment grade, BB or lower, are called high yield or junk bonds. Since these bonds have a higher risk of default, investors demand a higher coupon payment to compensate themselves for the risk. I think S&P is the most popular rating agency. They have offices all over the world, and they rate bonds for all different types of companies and governments. You're probably more familiar with the S&P 500 index. The S&P 500 is a market cap weighted index of 500 publicly traded companies in the US. This index actually includes 503 stocks because 3 companies have 2 shares listed. For example, Google, GOOG or GOOGL. So the S&P 500 is not a list of the 500 largest companies in the US, but they are 500 large companies in the US. I call it spiders. So spiders is one of the best gauges of US equities. The S&P 500 index was launched in 1957 by this company, of course. It's a float weighted index. The market cap of the companies in the index are adjusted by the number of shares available for public trading. You cannot invest directly in the S&P 500 because it's an index, but you can invest in one of the many funds that use to benchmark and track this index. For example, ticker SPY or ticker VOO. The best rating S&P offers is AAA, and the worst is single D. If your town has a BBB rating, they may pay 7% interest on the debt they're issuing. If the next town over has a AAA rating, they may pay 4% interest on the debt they're issuing. So the next town over is paying a lot less interest, which is what you want if you're issuing debt. Let's talk about duration again, since it's not the most straightforward topic. So as you know, bonds will rise or fall in value as interest rates change. The sensitivity to changes in the interest rate environment is called duration. The term duration can be a bit confusing for new bond investors because it does not refer to the length of time the bond has before maturity. Instead, duration describes how much a bond's price will rise or fall with a change in interest rates. We're going to do some math in a little bit, but I just wanted to touch on that topic again. So the bottom line, bonds are issued by companies and governments to finance projects and to fund operations. And most people call bonds fixed income, since traditionally they paid a fixed interest rate to debt holders. Investors can purchase corporate bonds through financial institutions. So if JP Morgan issues bonds, you can buy it directly from them. You can also buy it through your broker. If you buy stocks through Schwab, they also offer bonds. Or you can buy it directly from the US Treasury. Or if you don't live in the US, you can buy it from your government. Let's do some math to really drive the point home. Let's say you bought a bond for $1,000, a 3-year maturity. It paid you a coupon of 7%, but rates have gone up, so the yield to maturity is now 8.5%. The yield to maturity is a calculation assuming you hold the bond until maturity and you reinvest the interest at the same coupon at the 7%. So when you first bought the bond, the yield to maturity was 7%. But the yield to maturity changes based off of fluctuating interest rates. But if we want to trade this bond in the open market, we can't get $1,000 for it because rates have gone up. You can tell the yield to maturity is higher than the coupon. So we know the bond is worth less, but how much less? Well, let's do the math. First, we need to calculate how much interest the bond pays. The bond always pays interest based on the coupon. 7% coupon, $1,000 face value. The person that owns this bond receives $70 of annual interest. So this is how you calculate the price of the bond. You have to present value the cash flows you receive from this investment. After year 1, we receive $70. At the end of year 2, we get $70. At the end of year 3, we get $1,070. We get 70 plus the face value, what we paid for the bond. Then you have to present value these numbers based on the yield to maturity, which is the current rate. So for year 1, we take $70 divided by 1 plus 8.5% raised to the first power. So 70 over 1.085, which equals 64.52. And then we present value the year 2 cash flow, 70 divided by 1.085 to the second power. And that's 59.46 in today's dollars. And then we present value year 3, 1070 over 1.085 cubed, which equals 837.71. So if you wanted to trade this bond in the open market, you can sell it for $961.69. Since interest rates went up, the value of your bond went down. Let's pretend interest rates went down, so now your yield to maturity is 5%. Your bond is worth more. It's worth $1,054. And the reason it's worth more is because you're receiving a 7% coupon. And if somebody wanted to buy this exact bond today, they would only get a 5% coupon. Let's calculate the current yield. Let's pretend we paid $1,000 for a bond that paid 6.5%. The coupon was 6.5%. And now the bond is trading in the open market at $1,040. We want to calculate the current yield. Remember, even though the bond is trading at $1,040 in the open market, you still receive your $1,000 when the bond matures. The par, the face value, is what you paid, and that's what you're going to get at maturity. The current yield is calculated by taking the annual interest over the current market value. So the annual interest is $65, 1,000 times 6.5%. But the bond is trading for $1,040, so the yield goes down. We know it has to go down because the price of the bond went up, and rates move inversely to bond prices. Let's say the bond was trading at $900 in the open market. The yield went up to 7.22%. Let's say you want to calculate the yield to maturity on a zero coupon bond. Remember, yield to maturity is the rate of return if you hold the bond until maturity. Zero coupon bonds always trade at a discount. The interest is paid at maturity when the bond is redeemed. In this example, you pay $95,238 and receive $100,000 in 1 year. So that's really your interest, that $47.62. So let's calculate the yield. Here's the calculation for YTM. It's the price of the bond times 1 plus yield to maturity. That's the unknown. That's what we need to figure out. Equals the face value of the bond. Let's plug in what we know. The price the bond is trading in the open market, 95,238, that's right here, that's given, times 1 plus yield to maturity equals the face, what you're going to receive at maturity, 100,000. We need to isolate the unknown, the YTM. So we divide both sides by 95,238. Now we have 1 plus yield to maturity equals 100,000 over 95,238. So now we have 1 plus YTM equals 1.05. 1.05 equals 100,000 over 95,238. Next, we need to subtract 1 from each side. Now we have YTM equals 0.05 or 5%. So would you pay $95,238 to receive $100,000 in 1 year? That's a decent return, 5%. If this was a government bond, it's a really good return. If this was a corporate bond, it may be questionable depending on which company is issuing the bond. If interest rates go down, the price of the bond will go up. Say it's $98,000 a year from now. Now you're yielding only 2%. But if interest rates go up a lot, and say the price is $90,000, now you're yielding 11.1%, which is a really good return. So if you bought a bond today for $1,000 that paid a 5% coupon, which means you receive $50 in annual interest, the yield is 5%. And the yield should equal the coupon if you bought the security in the primary market. Say in a secondary market, this $1,000 bond was trading for $900, which means you pay $900 and receive $50 in interest. So your yield is 5.6%. Because if interest rates go up, the only way to sell this bond, this $1,000 bond that pays $50 a year, is to charge less for the bond. Because why would someone pay $1,000 and get $50 when the yield in the open market is 5.6%? So they could just pay $1,000 to the issuer of the bond and receive $56. So to sell the bond in the secondary market, someone needs to pay $900. They still get $50 of interest, but the yield is equal to the market. What if the rate on this $1,000 bond goes down to 4.5%? How much can you charge for the bond in the open market? Well, we know it's more than $1,000, but how much exactly? Since the bond is currently trading at 4.5%, you can charge more than $1,000. You could charge $1,100. The person who bought the bond paid $1,100, receives $50 in interest, so their yield is 4.5%, the same as the market. Let's do another example of duration. Say we own a $100 bond that pays a 4% coupon. Rates have gone up, so the yield to maturity on this bond is now 5%. So let's figure out the value of the bond and the Macaulay duration. The first thing we need to do is list the cash flows we're going to receive from this bond. This is a 3-year bond, so in year 1 we're going to receive $4, 4% of 100. Because we get paid on the coupon that's attached to the bond, not the yield in the open market. Year 2 we also get $4, year 3 we get $104. We get $4 of interest plus our $100 of principal. Next, we need to present value the cash flows based on the yield to maturity. Our first cash flow is at the end of year 1, $4 of interest. So we have to present value that $4. We take that number, then divide by 1 plus the yield to maturity, so 1.05, raised to the first power, since it's in the first year. I'll show you the formula right here. It's $4 divided by 1 plus the yield to maturity, so the 5%, 1.05 raised to the first power. Let's PV year 2 cash flows. The same formula, except we raise it to the second power. Since we're going to receive the $4 in 2 years, we have to present value it a little more. So $4 2 years from now, with a 5% discount rate, is $3.63. So this implies that $3.63 today is equivalent to $4 2 years from now. The last present value is 104 raised to the third power. The value of our bond right now is $97.28. That's how much we could sell the bond in the open market. Because nobody's going to pay $100 for the bond, because interest rates went up. As interest rates go up, bond prices go down. The purpose of duration is figuring out how long it's going to take to receive our principal and interest, the average weighting. So for each year, we're going to take the amount we receive over the total amount. So after year 1, we're going to receive 3.9% of our cash flows. 381 over 97.28 is 3.9%. In year 2, we receive 3.7% of our cash flows. 363 over 97.28. And a bulk of our cash flows is in year 3, 92.4%. That's when we get the principal. So the sum of these three numbers has to be 100%. The last step in the Macaulay calculation is to apply this weighting to the number of years. So we take 3.9% times 1, which is 0.04, 3.7% times 2, which is 0.07, and 92.4% times 3, which is 2.77. So when you sum these three numbers, it equals 2.88. So this tells us it's going to take 2.88 years to receive the cash flows on this investment. This also tells us if interest rates rise by 1%, then the value of our bond will decrease 2.88%. That's the Macaulay duration, 2.88%. And if interest rates fall by 1%, then the value of our bond will increase 2.88%. The bond value is opposite the change in interest rates. What if the yield went up to 9%? The value of our bond is $87. The duration has to stay the same. The only way the duration will change is if we change the cash flows in these years. I'll give you an example. Say we didn't get $100 of principal at the very end. We receive $50 in year 2 and $50 in year 3. So we still get $112, the 4% interest. The $100 of principal was split between year 2 and year 3. So that gives more of a weighting in year 2. In this case, the Macaulay duration is 2.42 years. So the weighting is lower because it's not as heavy in year 3. The lower the Macaulay duration, the less sensitive the bond is to changes in interest rates. Email me if you want a copy of this Excel file. My email is in the description of every video. And of course, ask any questions you want. So I hope this was clear. Let me know what you think. Thanks for watching.